Hello, friends, and welcome to the Optimized Advisor Podcast, where we focus on optimizing the well-being and best practices of insurance and financial professionals today. On this show, our objective is to help you optimize your life, optimize your profession, and learn from other optimized advisors. I'm your host, Scott Heinela. We hope you enjoy the show. Conor Anderson, managing partner with AdvisorAssist. Thank you for joining us today.
Absolutely, Scott. Thanks for having me.
I do really appreciate your time to spend with us and share some of your insights. As we were talking previously, you and I were introduced. This is a blind date of sorts, if you will, for you and I through a good advisor, friend of ours, Bart Zandbergen, was at a investment conference you spoke at. He mentioned you very highly and said, this is somebody you've got to have on your podcast, specifically sharing this information on how advisors can optimize their practice. And the topic of today is, at least at the highest level, and we'll unpack a number of things, but this RIA versus investment advisor representative, we're so regularly having these conversations today of advisors considering leaving their broker dealer. Of course, that's one element of things, and just going to be a standalone fee-based or fee-only advisor. And then this question becomes, well, do I become my own RIA and take on all of that responsibility? And I think the misunderstanding for many, correct me if that statement is accurate or not, of it's super simple and easy to do, and everybody can just become their own RIA and deploy all these different technologies and services, and off I go, versus going under the purview of an RIA and becoming an IAR.
Absolutely. And, AdvisorAssist, we are really in the center pinning of this discussion and project management for these advisors that have been part of the wirehouse their entire life. And they've come to realize, I think maybe I can do this on my own. But what does that entail for me? Right. I'm no longer just going to be managing client relationships, but now I'm actually managing a small business. And with that comes a lot of responsibilities around putting good infrastructure in place. And then in the back of your mind, there's always this thought, well, what about compliance? What are the regulators expecting us to be doing? And that's not me. I always had a compliance officer. So where are we right now? And how, what are the things that I don't know that I should be doing? And ultimately, AdvisorAssist, what we do is have those conversations, be a good partner, allow these RIAs to uncover those areas to help them build, to grow, to optimize, and protect their business.
So is that where AdvisorAssist mainly focuses, in that wirehouse advisor who's leaving the mothership, if you will, and going this independent route? Or what other forms of advisors do you experience?
Bulk of our clients that are net new to us generally come out of the wirehouse, right? They're looking to start up their own RIA, so that's a really good tranche of new clients to us. The other side is working with existing RIAs, small, medium, or large, around what their current infrastructure looks like, because they're always a lot of them are looking for the next new thing, or a better service provider than what they've had before. And we'll do a little bit of both, to be honest with you. But I can't stress enough that regardless of the environment that they're coming from or that they're in right now, as soon as they're talking to me or my colleagues here at AdvisorAssist, their eyes open to say, well, this isn't just compliance. You guys are actually looking at practice management. You're looking at control, infrastructure, governance, because at the end of the day, Scott, for us, that cliche that's always said out there is that compliance is everybody's responsibility, not just the CCOs.
All right. So I definitely want to circle back to that and close concisely with exactly some of the specific things that AdvisorAssist does and helps advisors, and the call to action of source. But let's start from the beginning, right? So in that context, advisor is looking around and making that big business decision of, all right, I'm going independent in some capacity.
Mm-hmm.
And my first real uh, uh, path crossroads is, do I align myself with already an established RIA, uh, and or become the IAR underneath them, or do I go this all alone? What are the some of the first things and high level decisions and decision points that they're going to be confronted with that'll help them navigate those waters?
Yeah, boil it down in short kind of bullet point there. It's for me, it's ultimately what control do they want, right? Are they an individual that are entrepreneurial, that they can have a business that they manage and maintain, their king, bottle washer, waiter, and everything else in between, in addition to being a leader and a CEO and a CCO and an advisor to their clients. Ultimately, a lot of our clients they're faced with that question, and they're game for it, right? They want to do it. They feel that they have the mindset and the ability to do it. Other advisors look at that and say, you know what? I'd rather go into an established RIA that's separate from a independent broker dealer, and tuck my business in, right? We are seeing a ton of that with our current clients that are established, that are looking for that inorganic growth. Though there's recruiters out there that are finding these advisors that are looking to go, and if they don't want to go independent on their own, tucking into an advisor. And the I guess, what's the word I'm looking for here? Because I know we're going to be chopped up here.
Hmm.
But they're the deals that they can make with an advisor that they're tucking into. Books open, right? Everything's on the table, and they're able to negotiate really good terms, and better terms, frankly, than what they're having with the wirehouse.
Yeah. So what does that look like in what you're seeing today from an acquisition standpoint? Just right. What's the pulse of today? Because it's been very hot in previous years. Is the market shifting a little bit yet or not yet? I mean,
It's the flight to independence has happened, for the last 10, 15 years in the US, right? I
right.
think there's been a little bit of peaks and valleys. Maybe we came, what the fear was, we were going to come into a valley in COVID time. But really what we saw, the business, our business, the transitioning flight to independence, it really didn't stop.
Yeah, probably
Everybody,
accelerated, right?
it really did. And there was some concerns maybe with the current environment, with the yield where we are, recession fears. But the clients that I'm talking to that are really at for this M&A business, they're gung ho. They're moving forward. They see it as an opportunity. The valuations of firms that are out there are what they are, and in order to get that high valuation, they know their assets, their advisor quality, and the client quality needs to continue enhancing, and it's not stopping.
All right. So I definitely want to talk a little bit about what you're seeing from a valuation standpoint. The typical multiple is somewhere in the range of 2.5, right? And we're hearing and seeing multiples significantly beyond that. But there's also some confusion, I think, in terms of what specifically the multiples are valued on. So, what are you seeing as the main one or two valuation methods that are seeing, and what is being valued today?
Absolutely. So, first and foremost, it's AUM, right? The higher AUM, in my opinion, I think that's going to drive it. Second to that, probably 1A, 1B, certainly is the quality of the enterprise, right? Having a really good process, an internal practice that is sound, that there's significant reliance on good quality third party providers where the margins are really good, right? So if
Mhm.
they're able to control their margins, and they're able to control, the ongoing process, that valuation is going to shoot up, right? So, you're right. I heard a crazy recently. I heard a crazy valuation north of 20x on the sale of an RIA. Mind
That
blowing.
is incredible.
Mhm. It is. But again, the entity that's in, they have a significant business. There's complexity there, but with that complexity is simplicity, right? It's a good process and a good practice.
What are you seeing? So it's definitely easier, at least as a starting point, to value AUM. What do you see in terms of valuation of two other areas that I we see advisors and or agents have maybe a disconnect in the reality of valuation? But one would be insurance.
Mhm.
So, non-recurring revenue or maybe some recurring revenue. How do we value insurance within a practice that might be significant and very meaningful to that practice? And then two, a sales process or a sales funnel. What do we see in terms of valuations there?
Well, the firms that have um, revenues that's coming in outside of just assets under management fee based, right? Um, in the past, it's been heavy on the brokerage side. It's heavy on the insurance side. I don't think, in my opinion, that that's affecting that much of a valuation perspective as it once did. Right.
Right.
We're seeing again this flight to independence, the move away from the commissionable brokerage practice. It's not driving, in my opinion, that much valuation. Right. The insurance part of that, though, I think is helping the valuation because it's creating that universal wealth management, risk management practice for an individual client. So if an RIA can provide that, has a way of providing insurance offering to those clients, it's not leaving the house or the umbrella, so to speak, right? Staying within an RIA's organization, yeah, sure, it's going to hop up a little bit on that valuation.
Right. Okay. All right. So from a establishing, let's talk about starting the RIA. What are some of the things that you would say are like foundational best practices that'll help an advisor really get off to um, the right foundation to begin with, one, but also two, I think there seems to be maybe some confusion around, and I'm going to throw out the loose term, just how easy this is.
Sure, sure. No, absolutely. Well, it always starts with really good third-party providers, right? That's law firms, that's compliance consulting firms or regulatory firms. Sometimes they can be one and the same. And the third really is having a really good provider, whether it's a custodian. And then if you're so far as to have a TAMP that's going to handle your kind of investment practice or process,
Mhm.
trading, the client management piece. If you have those three, and you're able to understand what those three or four service providers can actually offer you, and you buy into that guidance and that advice, generally those advisors are better off when they do that day one transition. Right. We've seen a lot when it comes to from a legal side, employment contracts when they're leaving the wirehouses. If you don't have a sound and really talented law firm that's looking at your contracts, that's when the TROs come into play from for that advisor, which you get hit with a TRO, you're slowed down for accumulating that initial tranche of clients coming to you, right? If you don't have a really good regulatory partner, the registration process, whether it be with the SEC or the various states, you can have a number of missteps and not be set up the right way. If you don't have really good relationship with your custodian, you might not understand all the fees that your clients may be subject to, and that hits the profitability of a firm. Ultimately, we saw in 2019 this massive shift to zero with the custodians, right? Asset-based pricing, transaction-based pricing, the types of securities or investments that advisors are managing and holding on a legacy basis. Now they're independent. Are they able to maintain a similar book or similar portfolio? and what does that do from a profitability perspective? And then on top of that, they're open architecture now. They're no longer just subject to whatever the wirehouse effectively mandates them or puts on a available investment list for them.
Right.
So if those advisors have the ability to kind of work within these 4 or 5 components of their transition team, and they buy in, they trust us, ultimately their transition and their year 1, year 2 is going to be a ton smoother than if they didn't.
And so where does Advisor Assist step in and help with that process? I mean, I imagine there's a consultative approach and there's a very hands-on approach for those who are saying, look, I just need to partner with a firm that can help guide me properly.
Yep. So, we want to be the quarterback, to be honest with you, between all those parties, right? Because we've seen it. We've done, 10, 20,000 of these registrations over the years, right? So we absolutely want to be right in the middle of that and asking questions, getting the advisors talking about their practice. What have they done to date? And what are they looking to do in the future with their practice and their new RIA? The more we can understand from them, get their ideas out, we're going to be able to better guide them in terms of the best practice that they can put in place for their new RIA, right? And whether it's dealing with the regulators, whether it's dealing with the custodians or the other partners that they use as their team, we want to be right in the middle of it, because every one of those conversations is effectively going to create a needed control structure in place. And we want to be there to say, listen, you should do it this way because here are the benefits. If you don't do it this way, you're going to have potential gaps. And when there's gaps, ultimately, in our mind, that's where we see the regulatory issues come up.
So on that end, let's transition a little bit into this compliance supportive services and maybe talk a little bit about trends and audits. Navigating those waters versus the state and the SEC, dramatically different experiences that an advisor would have, I
Yep.
could imagine. So, yeah, what are we seeing in the realm of compliance and audits and just the regulatory environment as a whole?
In 2021, we started tracking much more data points on this on our end, right? And we went through north of 100 examinations with our clients.
Wow.
That's telling us that the regulators see and understand this flight to independence. They want to make sure that who is registered with them truly understand their requirements, right? Their obligations as a fiduciary in this space. And I will tell you that no one exam is similar to the next, which makes it interesting for us as a service provider, because when our clients, call us and say, "Hey, I've just been contacted by a regulator. They're coming in for an examination. What should I expect?" We try to create that floor for them of expectations, but any exam can go any different way. So we've seen a lot, and we can tell generally pretty early on if a regulator is going down a track, and what they may see from a public filing or what they may see from initial conversations with that CCO or owner of an RIA, where we can really need to step in and help guide the exam as best as we possibly can. We started tracking the common deficiencies with these examinations, and to be honest with you, it's almost bread and butter stuff. It's lack of disclosures. It's presenting service offerings and fees to clients, and a failure to disclose conflicts of interest. So as I
Hmm.
said earlier to you, where do we sit in the registration phase? We want to be in that quarterback position and ask the questions and get our advisors talking to us, because the more they tell us information about their infrastructure, their business partners, their practices, we're going to understand a lot more from a conflicts of interest perspective to allow for disclosures and mitigation of those conflicts that hopefully help the examinations that may come 6 months, a year, 2 years, even 5 years down the road. If we have a good understanding of that early on, we're handling a lot of the regulatory issues that may come up out of those exams.
So let's talk a little. The thought that initially comes to mind is like, what a distraction, and um, so many of these type of firms are running pretty thin. It's a small team. Uh, they're very entrepreneurial in nature.
Hmm.
They're working. The optimization of their time and value is directly with clients, and developing those relationships and working on financial plans and all of that. Uh, Talk to me a little bit about how disruptive an audit could be to a firm.
It can be very disruptive, right? Especially if you don't have a good partner that helps you through that practice, right? Because again, you're dealing with a regulator, whereas in the past you've never had to. You may have had to sit in a arbitration hearing or discussion with a FINRA auditor or what have you. The minute that now that they're in front of a regulator, that's not their bailiwick.
Hmm.
So with us and our practice, our process, we design the exam support in a way that we're lowering those emotional reactions and just getting to brass tacks. To be honest with you, this is what they're asking for. This is what they want. This is why they want it. Let's wrap our heads around that ask and be able to educate you before going into an examination. Because if the better they're educated, the better that they can formulate responses. In our opinion, the easier the exam goes.
Right. Yeah. I mean, that's a good point. I imagine that if, depending on the size of your firm, if you've got the SEC in there, they're going to be in there for many days, and you are not conducting business when you are dealing with an audit.
It certainly is. It takes away, especially if you're that producing advisor that may have a control position, whether it's you're the CEO or CCO and you're looped into the exam. Yeah, you're definitely taken away. And the unfortunate part is we don't know how long these exams go. The SEC, for example, they have publicly said out there that their exams they want to ballpark at 180 days. We've certainly seen exams that go well past 365 days that remain open, right?
Wow.
And there may be a 3 month time period where the advisor doesn't hear anything from them, and they call us and say, is this an issue we haven't heard? And at the end of the day, from our perspective, no news sometimes is good news because
Right.
these examiners they've got multiple exams that they're making their way through. So they pick one up, they get through an understanding. They pick one up, they go through the process, right? And then for one exam, and then they close that out and they go to the next exam. So depending on the flow of the examination, how the conversation is going, what topics they're hitting on, it's going to tell us really, we need to be a little bit tighter on our next response here because of potentially we see this going in a certain way.
Yeah, that's great insights. All right, so going on, we want to talk a little bit about other industry trends. What are we seeing, industry trends? Maybe we could cite a couple, and then we'll be running out of time.
Absolutely. So, number of industry, we've already hit a little bit on one of the major industry trends, right? And that's the M&A, right?
Right.
These advisors that have been out operational for 5 years. They want to see their valuations of their business go up higher. What does that mean? How do they do it? They're really interested in finding inorganic growth, right? It's that tuck-in advisor. I've had a couple of conversations with some very close clients of mine saying, I'm not just interested in tuck-in advisors anymore. I'm actually interested in merging forces with another existing RIA. What does
Right.
that mean? Right. So we're having those conversations with them. And, to be honest with you, from a regulatory control perspective, when you're in that conversation or you have that desire to tuck in or merge with an RIA, the advisor, the owners of those firms or the control people of those firms that aren't asking the simple questions of whose control process is going to be the legacy? Who's going to remain going forward? How quickly can we merge operations? At the end of the day, clients' best interests have to come first, right? So the firms that have the ability to understand that merge in an expedient manner, almost like there wasn't a blip in operations or client service. Those are the ones that actually are really good at that M&A. ones
Yeah.
that are struggling with it, they don't have a good practice already in place. They don't have the foundations, in our opinion, to be able to tuck in, a large team or an existing RIA.
Yeah, it's an interesting point too. The other thing that what you're really referring to is a lot of the what I would classify as the X's and O's, the process of the organization, having the people in place, who's doing what, is there overlap, how are we going to deal with overlap? Those are some um, again X and O conversations. Not easy, but X and O conversations. The other part that I think about is kind of if you think about merging firms together as a partnership, it's kind of like trying to weave together fabric and the core values and the culture of those firms is where my mind goes and that's probably a pretty challenging probably harder to find.
It is, and the ones that do it really good have a knack for cutting through a lot of the minutia and the noise to be a little bit more direct maybe, and can solve that problem that's facing, because there's a time component to this that they know that they have to address, and get beyond before they can go on to the next one, and not lose brand awareness, not lose client relationship or reputation.
Yeah, it is an exercise to me of not every shoe is going to fit and the more that i.e. the existing firm, what your core values are, kind of who you are as a firm and who it is that you're aiming to attract in terms of your clientele, the easier that those relationships and those opportunities will materialize in a profitable manner, and
Absolutely.
profit not just in dollars but profitable in all the other intangible benefits as well.
Absolutely.
All right, what else are we seeing? You mentioned a little bit
You
about outsourcing.
Yeah, outsourcing. So, we all saw, at the end of October, the SEC announced a new rule proposal that was put out there. Not shocking to us because the exams that we've been through over the years has been around third-party vendor management and due diligence. So this oversight of third-party providers. Service providers is certainly a major trend, right? Because the independent space is really built on the ability of an individual RIA to go to a specific uh, CRM system that they really think is best for them. The cost is right. In addition to the CRM, they've got billing services. They've got all of these providers out there, and it's a burgeoning, blooming, value prop for them. With that comes a responsibility of that advisor to make sure that they're doing as much due diligence, initial and ongoing, for those product providers, right? And it's no longer at this point just at the third party tech and service providers, but we're also seeing it on the investment side, right? There's products out there that are just coming up every day. You learn about something new. You see trends for these RIAs that they're putting their clients in, right? Private funds have been opened up a little bit more for what I would call, while they're still qualified accredited investors, right? It's becoming more of a norm for our clients to say, hey, I want to have my clients have access to this. What's a concern for this? And at the end of the day, without really good initial due diligence, education of your clients as the risks to investing in those types of securities, liquidity concerns, and the like, advisors may not think through that process. And they're putting clients' assets in there, and I think that's where we're seeing some of these SEC exam priorities come from, because of what this landscape and this marketplace looks like for the advisors, because it's opening up the doors, and it's like, whoa, we have open architecture now. I can have access to all of these, generally speaking, without proper due diligence. That's where
Hmm.
the SEC is going to come in, or regulators are going
Hmm.
to come in and say, we didn't do enough here.
Yeah, it's a very what you just said actually brings a lot of clarity to it. Now it just opens up for a lot of ambiguity and easy insertion points from a regulatory standpoint to ask questions. And you better
Absolutely.
have the answers. You better be prepared. And there's where you probably can't stress enough having resources like Advisor Assist in their back corner.
Absolutely, because again, what one of our fun taglines we like to say is, if you don't document it, you didn't do it, right? You have to have ways to back up your claims in a pitch book to a client, that you have a robust investment due diligence process. Regulators are going to say, okay, let's talk about this robust process you have. And if you don't have something that even scratches the surface of a robust process, it's easy pickings for a regulator.
Yeah, I've never had somebody sued for over disclosure and too much documentation.
Absolutely.
Yeah. All right. Well, in closing, let's kind of recap where Advisor Assist steps in, who you're looking to shoulder and partner with, and where can they get a hold of Conor Anderson.
Yeah, absolutely. So, our sole goal for as the advisor to advisors, we want to be able to provide our clients with best practices. That's not just, oh, you should do this. It's, you should do this, and this is how you do it. Oh, by the way, here are vendors that you should utilize, right? So we're really on a mission over the years to find the best that's out there. And allow us to kind of do that due diligence and provide a number of solution offerings to our clients to say, hey, if you're faced with this type of a need within your practice, here are some vendors that you should utilize, right? That's going to help optimize your business practice. And truly, as I said, I can't stress enough, we want to be advisors to them. We want to know about their practice almost more than they do, right? So that when that regulation or that regulator comes to them during an examination, we're able to kind of sit shoulder to shoulder with them and be able to guide and do the things to help that process, right? Because the adage is that's going to help them sleep better at night,
Mhm.
for sure.
Yeah. Yeah.
So,
Absolutely.
where to find us, advisораssist.com. We don't try to be the only product or the only solution out there. There's a number of really good consulting firms in this space. We're just one that we really want to extend beyond that compliance and become that truly trusted partner from a practice management, regulatory management, and compliance.
Wonderful. Well, thank you very much for your time. This was very insightful. And thank you to all of our listeners for tuning in. Until next time.
Thank you, Scott.
Cheers. Thank you for tuning in to today's episode. Please subscribe, like, share, leave a comment or review. Be sure to check us out on social media at Optimized Advisor Podcast. Till next time.